how you're able to make this thing. Well, it means here from bank's perspective it is portfolio, but from client's perspective, you see, when client approaches you for the first time for any loan, you have to go through this concept of credit appraisal. Okay, so in this particular presentation we'll try to see, is the credit appraisal process same or it's bit different when it comes to international banking. Okay, so we are going to look into the same. Let's start with it. Now you see, evaluating credit worthiness for cross-border lending and trade finance is a very important job. If you are not able to do thorough investigation, and by any chance you're doing a wrong loaning, you see, if you're giving a wrong loan to a party without doing proper documentation or without getting collateral, you see, there is a high chance that this particular loan will go into NPA. To avoid a loan going into NPA, so what is the most important part is, like, you have to be very careful doing this credit appraisal of your party. Okay, so you have to look for various factors which brings in your risk into your particular contract, and you need to be taking care for the same. Let's proceed further into it. Now you see, look into the global economic landscape. Now we are dealing into international banking and credit appraisal. Imagine you do have a party, your bank, let's say you have, you're a bank and I am your client. Okay, I'm an Indian client and I'm going to do a transaction for bringing in, let's say, product one. This is my product that I'm going to import from another country called as Zimbabwe. Rather than bringing in, let me send it to Zimbabwe. Okay, so I'm sending a product called as product A to Zimbabwe. The client who is going to import this product from Zimbabwe is an unknown fellow. I don't know, because the world is a global market and I can get clients from all across. So there is a client, Mr. A, in market Zimbabwe. Okay, so he's asking me to send some goods. Now when I'm asking him for making advance payment, he is having some, like, you see, he is not trusting my company, my brand. So maybe the moment I am getting the payments in advance, he may not be able to get his product on time. Hence, he has certain reservations. So he has just paid me 20% and is expected to pay the remaining 80% after the delivery of the goods onto his premises. You see, in today's world, in order to get more of your market share, what is required is, like, you need to give people some credit period. Okay, this may be a second situation where I'm giving this Zimbabwean client of mine a credit period of 3 months. Yani within next 3 months, he is expected to make me a payment. It is not upfront. Okay, I need to wait for 3 months, and after 3 months, I'm going to get this. I am again, now you see, like, he is doubting my credential, I'm doubting his credential. So there is a conflict going to be there. So hence, in order to have smooth trade, what is required is, it's important that we bring in some instrument or some mechanism through international banking which gives me a surety that I'm going to get my payment from my counterparty, and he's also getting a surety that his goods will be delivered to his premises as per the specifications made in the initial contract. Okay, so the concept here which is being used is letter of credit. So the borrower here, who is borrowing it, he is the buyer. He is going to give me my payment after 90 days. So what I'm trying to do here is, I am expecting my Zimbabwean client A to give me a LC which is issued by their bank in favor of my company, so that on maturity date, if Mr. A is unable to make me a payment or he is not able to pay my money back, then I am going to approach his bank. Okay, so this is letter of credit. So if you cannot pay, your banker has to pay. So I want a guarantee or a surety. So your banker is willing to give you a surety. You see, it's not so easy to get a surety from a bank. Bank will be expecting you to give some collateral, some security, which is more than the loan amount, so that if something goes wrong, they will be able to recover. And they are, because they are entering into a contract for which they are charging commission. If something goes wrong, they have to pay it from their pocket. Okay, so this is letter of credit. So when we are dealing in global phenomena, these are some documents which help us facilitate global trade. Okay, and here on this slide, what we are trying to see is, like, India, and there are approximately 200 countries on this planet. Okay, every country situation is not the same. Like, you see, Pakistan, Sri Lanka, they do have disturbance all across. When I'm saying disturbance, is economic disturbance. Inflation is very high, currency valuations are very poor, you are not able to get international loans so as to support your economy. talk is going on between these countries and IMF. So you need some good friend in tough time. Okay, now you see what I'm trying to put in here is when you are trying to be an exporter and would like to do something, a trade with some other country, you need to rely on the data sets given by Reserve Bank of India, your central bank. Now you see central bank on periodic interval will keep on issuing country specific ratings. Now you see if you want to engage in any transaction with Zimbabwe, Eritrea, Somalia, Mali, Ghana, Zimbabwe or any other country ABC, you see what you can do is like you may you see imagine I'm taking you to a different context. Imagine you go to Delhi. On Delhi railway station you are asked by various like hotels for your stay. You see in same market you can get an accommodation for 5,000, and in same market with same facilities you may get an accommodation for 2,000 rupee. Now you see, so hence what I'm trying to tell you here is like standardization is not there when you're dealing in market. This is a very big market, and it's very tough to understand what is actually going on in your market. And information is not freely available. Is not uh, everything is not transparent. Hence, what you need to do is like you need to follow the regulatory approach very closely, where they define a list of secured countries where you do a trade and your money will be safe, and they'll also issue you a list of countries where it is very dangerous to have a trade relationship, because if you enter into a trade and you don't get your payment, recovery is very tough. Okay, so RBI's investment ratings for country should be looked at very carefully in order to decide whether to enter into a contract or not, because this will help you to get your coverage, this will help you to get your sum assured, this will help you to get your, you see, whatever amount is blocked in this particular transaction. Let's move forward, because now we have seen that it is global market, and then you have to look for global phenomena. You have to be very very careful. Now you see, now we are going into country specific factors. uh, I called a country name called as Somalia. You know, sea pirates. Now every second day you must be hearing in news that you see there are some countries who don't have good relation with Russia, this USA and European nations. Hence, due to this Israel and Palestine war, what they have done is like they have started creating trouble in your this you see Middle East zone. So what they are doing is like they are not allowing free movement of ships, and there are pirates who are operating in this particular zone. Now you see, what I'm trying to tell you is like if you have a law and order issue, it will affect your trade negatively. But if you don't have any law and order issue, like in India, you don't have any problem doing a trade anywhere in India. But if you cross the border to neighboring countries, you'll find it, even though country you do have a democratic setup, but it's very tough to operate in certain districts or provinces in your own country. Why? Because you have law and order issue. Yani, you see, there is a place called as Baluchistan, and this is in a neighboring country, Pakistan, where you see government and civilians they are fighting against each other. Cross the border on the other side of your country, go to Myanmar, or the other name of this country is Burma. You will find there civilians, like they what they have done is like they have raised arms against their ruling government. Now here actually what happened is like it was a democratic country earlier, but later on military took over the charge. They had a military coup in their country, and politicians have been put behind bar. So it's very tough. Civilians and people who don't like this idea of military taking over, they have started fighting against their own government. So it is very problematic. If you try to give any loan exposure to one of your client who has an exposure to such an area where trouble is there, you see there is a high probability that you may lose your money. I'll give you one more example from Surat. You see, Surat is an industrial city of India. It is in Gujarat. Now, you see, during COVID, what happened? There are these businessmen, they export, you see, textile material to various countries outside India. So, in one area, it was like in Afghanistan, they had some trade relations. Okay, this client has good trade relations with Afghanistan, so they were selling goods on credit, 30 day, 60 day, 90 day, depending on the credibility of your counterparty. Now you see what happened is like in no time USA left Afghanistan in midway, and Afghanistan government, ruling government, was taken over by Taliban. Now you see this change of power from normal democratic setup to Taliban government is very disruptive. Now you see the clients who have their exposure in Afghanistan were expected to get some foreign exchange for the goods that they have sent. All those transactions have been blocked. Now you see, imagine I'm a bank giving a loan to one of my party who is sending goods to Afghanistan. Now because of change of this government, you don't have any stable place, or you don't have any mechanism to raise your query or your grievance. And you see what is happening is like maybe your amount that you have invested in this country is all going to be forfeited. If customer is not going to get anything out of this contract, how he is going to pay you back? So it is going to trigger you an NPA. So this is very important. Okay, these factors are very important when you're into international banking. You need to understand the state of economy of that particular country. You need to see their rating, their political stability, their economic condition. Everything has to be looked at. Okay, now assessing a country risk factor. What are the factors that you need to look at? They're asking for economic indicators. Economic indicator means you need to look at the country's GDP growth rate. Is country growing? Is it positive or negative, or is it stagnant? So if your country is growing means it's good. But if your country is stagnant is a caution. And if your country is having an inverse GDP, inverse means negative GDP, then it is a cause of concern, because you see, yes, dealing with someone where there is negative situation, and maybe they will not be, even though their intent is not bad, but they, due to economic conditions, they will not be able to pay you. Okay, next is political climate. You see in Pakistan, Imran Khan is in jail, entire family is put under house arrests. So it is very turbulent in this Pakistan. If you go to the other border, Bangladesh is there. Now you see, recently, lately, Bangladesh is a country who is friendly to India. But now you see, there are movements which are actually being run by political establishments, maybe the opposition party and not the ruling party, where they have where they are promoting anti-India campaign. Now you see, if it is India favor, then it is good. But if it is anti-India that is being promoted outside India, it means it is going to affect your business. Not only this, you go to USA, Canada, Australia, you must have heard so many cases where you see Sikh people, they are having a conflict with their own partners from India. Yani they are having a conflict with other religions from India. Why? Because you see, they don't want to collaborate with Indians anymore due to their own political reasons. So if there is a political disturbance going on in a country, that leads to instability, and maybe this is where your bank or your exposure to this particular party who is living in this country may be running into heavy risk factor, and maybe you will lose your exposure, entire loss. So is there any agency who helps you cover up your loss in a foreign country? You see, day before yesterday, in one of our previous presentation, I told you that in India, all deposits in banks, they are insured by DICGC. Okay, Deposit Insurance and Credit Guarantee Corporation. Now you see, what is Credit Guarantee Corporation? Credit Guarantee Corporation is a body which takes care for your funding requirements. Okay, so if you have taken an exposure in a foreign country, and then that company is not repaying you anything, and there's a conflict going on through court and all. Now you see, for this such cases, because there is a default. Okay, default means there is no payment from counterparty. So what institution is going to do is like, institution is going to try bring in some buffer, some reserves, some provisions, from where they'll take out the money and will try to settle these accounts. Okay, so geopolitical risk. Now you see, Ukraine Russia war, Israel Palestine war, the Taiwan China war game which is going on is again creating trouble. India China border dispute is a problem. Sri Lanka is allowing China to use one of their port, and you see that ship is not doing anything except, you see, they're trying to collect information from Indian seas. Okay, how is India going to react? What is the reaction time? Because once you do it and they have the exact information, so they will retaliate accordingly. Okay, so now you see, geopolitical risk will again have a pressure on certain banks and their countries. Natural disaster can also be a problem, terrorism, civil unrest. So they are some of your geopolitical risk factors. Now let's go into evaluating industry dynamics. Now you see, if I'm going into international banking, I have to lend at a very competitive rate. Imagine if international market rate is 4% and my local rate is 12%. Do you think I'm going to go and lend it in foreign market where it is only 4% earning, and in my own market I'm getting 14% return? So rational says you should always go for a, like you should try to give it to a party where it is very high. Rate of interest is very high. Why are they ready to pay you high rate of interest? Is like they must be having some limitation. Maybe like you see, you don't have collateral or you don't have credibility, you don't have any background, loan expectation is very high. So if you have all your requirements like this, bank can ask you a rate to help you in your given situation. So pricing strategy can be changing according to the nature of your client. Product differentiation can be there. Industry consolidation may bring in barrier to entry. You see, consolidation means what? Merger and acquisition. Okay. So if you have any merger of acquisition, barrier to entry means blockage of your entry, because you see NSE, or let's say RBI is a regulator for banking sector. If you want to do banking in India, you need to get a license from RBI. If you are not able to do the documentation or prerequisites as desired by RBI, you will not be getting a license. So now you see, this is what is actually bringing in certain checks of new player entering into market. Okay, so if you allow it free, people will come and go, and this may have like you see, things are going to be very tough to manage when it is totally free. Similarly, in foreign exchange, you see what happens is like there is a check on how much can you bring in and how much can you take it out, because if you don't put in a check, you don't have any control. Okay, same is the case here also. Banks are operating under RBI or central bank's control. If you are not able to do it as per their instruction, they may send you out. Okay, they may not accept you as a partner or a player in market. So you see, market is always open. If you feel you can join, if you feel you cannot operate, so market is always giving you an exit option. Next is growth potential. See what type of industrial growth is there in this country. So now you see, when you are taking an international exposure and one of your client is having a transaction requirement where you have to finance them as a lender. Now you see here, this is very important. Industry overall growth is required, industry trends, future projections, identity, all of them they are required. So once you have it, you understand your market well, and accordingly you can take your exposure. Next is regulatory requirement. Examining relevant laws, policies, industry regulation that can impact operations, compliance, and risk exposure. Now, you see what they are trying to tell you is, like you see, regulatory environment. Don't say it as a regulatory environment. It is the need of our. So if you don't put in a regulation in place, you see market will lose all the dynamics. So it's better to put in some rules for everyone. So, and who is doing it? It is again, you see, self-regulatory agencies, or you volunteers. They step in of their own and then they bring in some solutions. Okay, now you see, is examining relevant laws, policies, industrial regulations that can impact operations. Now you see, these are very important. You don't have any control on it, so they will be coming in as and when there is a change. You have to implement immediately. You have to implement. So compliance is must. Risk exposure will also be there. Now you see, you cannot be exempted on any ground. If there is a change in a policy and you see change is implemented from a particular date, after that date everyone in bank has to follow it. You don't have any choice. Supplier relationship is again important. Why? Because when you're dealing in international banking and you do have a client where there is a loan requirement, you need to see whether they do have stable and like they do have multiple suppliers who are in connection to them, so that if one supplier is going down, you can shift to supplier 2, supplier 3, supplier 4. And most of them, they have done their documentation or they have undertaken a contract. Hence you see, your supply is not going to be disrupted. So if there is a disruption in supply chain, then there may be a problem. Okay, so then there can be a problem, and ensuring reliable and cost effective sourcing is what is very important. Now you see, next is like we are going to analyze the financial statement, okay, of your client for whom you are going to entertain this credit appraisal. Now international banking also have the same dimension. Like you do have a trader who is actually into either import or export and would like to have some financial assistance from your organization, you need to check their profitability. And this is supposed to be for couple of time frames, like it should not be only 1 year profitability picture taken into account. So it should be like, let's say you go to a bank, and in this bank if you ask for a loan, they'll ask you for 3 to 4 years of account statement. Account statement means ITR return, your profit, audited books. When I'm saying audited means chartered accountants are going to do your auditing. So we will be looking into your profitability, and we'll be seeing it how, what is your trend going to come in. This includes your revenue picture, this includes your expense picture, and overall income that you are able to generate. Next is like important dimension for evaluation of a client is you do have liquidity evaluation. So liquidity evaluation means this is on working capital requirement. So we'll be looking into your current asset and current liabilities. And you see, liquidity evaluation is very, very important. Why? Because if you're not able to maintain your working capital requirements of your own or from some source, you see, it is going to affect your production, it will affect your supply line, it will affect your recovery. So everything is going to go down. So hence it is very important that you should understand how you are going to fulfill your day-to-day requirements. Next is your leverage requirement. When I'm using this word leverage, leverage means use of debt. Okay, so if you have a if you have a usage of debt, then it is like it is going to be a little bit volatile. More of debt means more of interest obligation. So maybe possible that whatever profit you are earning is all going into debt repayment. So for new lenders, it is going to be a bit tough for getting an exposure into this company. So it's very important that you should always try to go into companies where debt equity ratio, you see, you only have equity. But in a competitive environment, you see every company will have some sort of debenture. So we will have some sort of leverage usage. Now you see what you need to do is like, if you cannot offer them the best rate, at least offer them the rate which is given to them by your competitor. So here interest rate negotiations is what is very common. So a credit appraisal allows the entity to have like you see accounting for their profitability, liquidity and leverage ratio, and accordingly we do define their credit worthiness. Okay, so with this I hope we'll be going into this concept of determining credit worthiness. So financial analysis, as we have discussed just now, industry benchmarking, you see where do you stand in industry will be taken into account. Management evaluation means the people who are running your company, the top management, their background and their experience is actually required to be there. Now, risk assessment is like identify and mitigate potential risk is like what is important. Regulatory framework changes, everything is to be taken into account. Now, mitigating risk through collateral and guarantee. You see, any loan, any bank, you must have seen that they do ask you for collateral and guarantees. So, if you are giving a loan, let's say to a party which is 500 crore or 1000 crore, so you have to get some securities. And in case of trade finance, you see what you can do is like you can take the collateral of uh, debtors, you can take stock into like into your account. In stock and data you do create a concept called as charge, that is hypothecation. Okay, you can also take the property, personal property of partners as a collateral. You can have the building and plant and machinery of your of, client can be used as a collateral. So but when you have a collateral, then things are very easy. But if you don't have a collateral, then we'll go with someone who is having a better like you see net worth, and this net worth is in line to what type of loan you're taking. So if you have a guarantor, or you have someone who is co-signer, means co-obligant. Co-obligant, I'll give you one easy example of co-obligant, means father and son joining the education loan document of a son. So you see, father is going to be co-obligant. If son is not going to get a job, and or he is not going to pay the installments after the completion of loan period, then it is your father who is going to do it. Okay, so co-obligant should be there. Then comprehensive risk assessment scale should be taken into account. So now you see, regulators keep on updating banks on various parameters that they have to undergo while doing this credit appraisal. So the same scale has to be drafted, and every client should be evaluated on the same rating scale. Okay, so scores are there. uh, you see, credit scores are there, and these scores give you an idea whether this party is risky or not. So you see, mitigation plan should always be brought in place. If you know the party is bit doubtful, pay premium, get a coverage. Okay. Now we are going to look into negotiating favorable terms and conditions. Now you see, understanding lenders' priority is very important. Leveraging negotiations tactics is again very important. You see, a person who is good in negotiation can get a product at a lower price. Now it is not supposed to be there everywhere, but in banks again, if you have a bargaining capacity, you can always get a better rate. Okay, but let's say you are going to take a loan of rupee 10 lakh and you have another requirement of, let's say, 50 lakhs. So you can, if you tell them very clearly that you do have multiple cases, and it is only possible that both the cases will come to one bank only when they give us the best rate. So you see, this is how you need to bargain and you need to negotiate. Okay, offer collateral and guarantee will bring in some favorable conditions for you. Monitoring and reviewing credit exposures. So this is a regular ongoing task for a credit manager. You need to go for on-site inspection. You need to go for off-site inspection. You need to now you see, when you are going for inspection, is what you are trying to do is you are trying to do risk assessment of your party. Physically, you're visiting. Okay. Similarly, wherever you have invested your money, you see sometimes these investments may have some early warning mechanisms in place. Means if you come to know about something which is unusual and is not the regular feature, or like a party is paying regularly for last 2 years, but now for next couple of months they have not paid anything, is a good indication that there is something wrong. So you need to intervene, have a word with them, discuss. And like you see, this thing usually happened. This sort of phenomena occurred in 2020 when large number of people, business houses, were not able to pay salary to their staff member. Why? Because they are also choked up and they are not getting any funds from anywhere. Okay, so this is a similar sort of situation. Reporting and escalation is important. Periodic review of portfolio is important. Now you see, bank is actually an institution who is taking loan exposure worth rupee thousands and thousands of crore rupee. So you see, review is something very essential
You
nowadays.
have 5 minutes remaining.
Use technology to leverage the situation. Now you see, what do you do? Leveraging technology means you are using technology to improve your like you see to improve your scoring or to have bullseye hit. Okay, so what you're trying to do is like you are using AI, machine learning, big data analytics. What are you supposed to do with this is like you are trying to do certain analytics, data analytics, and coming to a conclusion whether these cases are going to be good or bad. So you can predict the default probability of an individual or a case, and accordingly you can take your call. Okay, so this is only possible when you use technology. Manually, it is all not possible. You see, if you bring in technology, credit decisions can be taken very fast and will be much more effective than how we do it in case of manual code. Okay, so with this, let me close this session. Good day.